All right, the bell has rung on the first session of 2026. Let's get straight to the scoreboard. S&P 500 up a pretty muted 0.12%. The Nasdaq actually shed 0.08%, and the Dow added just 0.15%. So we're basically flat across the board. What's the immediate takeaway from that?
Okay, yeah. My first read. A choppy mess.
Yeah.
Just a
Yeah.
total lack of direction. This screams rebalancing bias. It's not conviction. It's just large cap desks being forced to deploy their fresh 2026 capital.
So just moving paper around.
Pretty much. I mean, look, nobody's committing. They're waiting. The holiday liquidity vacuum isn't quite filled, and, everyone's holding their breath for that first inflation print.
Right. But here's the contradiction. The volume. Despite that dead-in-the-water price action, volume today finished 18% above the 30-day average. That's a huge number for a flat day. How does that compute?
It computes perfectly if you just throw the idea of conviction out the window. Think of it as institutional mandate deployment. Fund managers have a pile of new cash and a mandate that says, put this to work, they have to buy.
But if they have to buy, why didn't we rip higher? Why didn't we close up 1.5%?
Because for every mandated buyer, there is a seller waiting. That's the whole story. It's a massive tug of war. The buy-side deployment is just getting soaked up by sell-side supply. People are using this new year liquidity to dump positions they didn't want to carry into 2026.
So it's a changing of the guard, not a breakout.
Exactly. Just a turnover.
And the sector performance backs that up completely. Energy was the big winner, climbing 1.4%. Meanwhile, tech was the real laggard, down almost a full percent, 0.9%. That points directly to the great rotation story.
Oh, absolutely. The money isn't flowing into the market. It's rotating within the market. It's coming out of last year's winners, high multiple tech, and going straight into cyclicals, into commodities. It's a defensive move right out of the gate. They're de-risking.
Let's talk about the price action into the close. That's always the tell. We had that classic January effect gap up this morning. Looked like we were ready to run. But then, in the last 30 minutes, a sharp 0.4% retracement on the S&P.
Institutions faded the rally. Plain and simple. They saw the retail euphoria, saw the chase for the new high, and they used that liquidity to distribute, to sell. Classic big money move.
They're not willing to chase these levels.
Not at all. Not with the macro calendar we have coming up. So, the implication for you, listen right now, is you have to expect a range-bound grind for the next, say, 72 hours. The smart money is staying liquid, not getting levered up.
Okay, let's get specific because this is where it gets really interesting. The leaders, the Mag 7 legacy names. Our data shows both NVDA and AAPL printed outside reversal days. That is a serious warning sign.
It's a huge red flag. I mean, NVDA opens up 1.5%, hits a new all-time high, and then closes down almost a percent on heavy volume. And Apple, it pierced its 200-day, couldn't hold it for a second, and just collapsed to the lows of the day.
So when the leaders open high and close red on day one,
it tells you the 2025 momentum has hit a brick wall. That is textbook distribution. The sellers owned that entire session after the first hour.
Okay, so if the generals are faltering, we have to check the troops. Let's look at the market internals. The advanced decline ratio finished at a pretty weak 1.2 to 1. What's that telling us about the health of this thing?
It's telling us the leadership is thin, and thin is being generous. A 1.2 to 1 ratio is nothing. Over 40% of the NYSE was flat or down today. This wasn't a rising tide. This was a few mega caps getting a lift from passive inflows, and that's it.
So no participation from the average stock?
None. The mid caps, the cyclicals, they were mostly spectators. The rally has no legs if it's just a handful of names. The index is being held up, but the foundation is weak.
And that leads right to the biggest red flag of the day. The divergence. S&P 500 hits a technical new high, but the equal-weight S&P, the RSP, did not follow.
And that right there, that's the whole story. It's a classic textbook bearish divergence. The cap-weighted index, the SPX, is basically lying to you. It's being distorted by a few AI names and that pop in energy.
So the truth is, in the average stock,
the truth is in the RSP. And the RSP is telling you the average stock is weaker than it was 3 weeks ago. The foundation is cracked. So for your positioning, you do not chase this headline breakout. You wait for a retest of the 50-day moving average.
Okay, but then there's volatility. This is the big puzzle. The VIX dropped 6% today, sliding toward 13.50. You just described a really weak, divergent market, but the price of fear is dropping. How do we reconcile that?
It is a contradiction, but it's a structural one. That VIX drop is just complacency fuel. All that year-end uncertainty is gone. The tax selling, the holiday liquidity issues, poof. So institutions are out there selling insurance, selling premium.
So they're betting on a quiet grind, not a crash.
Precisely. They're getting paid to bet on chop. And that raises a really important question for you. If downside protection is this cheap, are you layered into your hedges? Because now is the time to buy that insurance, not when everyone else is panicking.
All right, let's set up for tomorrow. Day 2. The market closed smack in the middle of its daily range, which statistically gives us a low probability of a strong trend day tomorrow, probably more mean reversion.
I agree. And the whole game for tomorrow is going to be about one number. The gamma wall at 6,850 on the SPX. There's a massive put wall, a safety net, down at 6,800 to 6,825. That should hold up the downside.
But 6,850 was the ceiling today.
A hard ceiling. For any kind of bullish move, we have to reclaim and hold 6,850. If we can't, we're stuck. And if we lose 6,825, gamma flips negative and we probably accelerate down to 6,780 pretty quickly.
But the real money wasn't in the index today. It was in the dispersion. The Philly Semiconductor Index, the SOX, surged 3.5%, which brings us to the high conviction trade from our research, long the semi-dispersion.
Yes, the market is very clearly rewarding the AI infrastructure plays, the data center, the memory, while it punishes consumer-facing tech. That's where the alpha is. You don't trade the index in this environment, you trade the dispersion.
So, long the AI winners, short the consumer discretionary names. Let's get specific. What are the day 2 plays?
It's all about memory. First, Micron, MU, closed up a monster 9.6% on huge volume. The play there is simple. You go long on any 30-minute opening range breakout. If it pushes past that initial high, institutions are going to chase. Target is the psychological $320 level.
And the other big one was Sandisk, SNDK, up 12%.
Yeah, SNDK is the pure play on enterprise storage, another key AI piece. That one is setting up for a gap and go. If it opens above today's high, you know the allocation chase is on. Desks still have quotas to fill, and they will pile into the names with relative strength on day 1.
So, to wrap it all up, the first print of 2026. The tape is heavy, we have volume, but absolutely no progress.
And a massive bearish divergence under the surface. The final thought for you is this. Don't chase the index. It's a lie right now. Focus your energy on that sector divergence. And keep your eye on the Russell 2000. If the small caps don't catch a bid by Tuesday, this whole New Year rally is a confirmed fake out.
Got it. The tickers to watch are CSPY, which is the lie, CRSP, the equal weight, which is the truth, and the VIVEX, which is the opportunity to get hedged on the cheap. We will talk to you tomorrow.